You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody, that music means it's that time of the month again. Yes, it is time for the Advisor's Option, the program where we break down what's going on in the crazy, wild, turbulent world of options for you, the busy financial advisor and asset manager. Maybe you're interested in dipping your toes in those waters, but they're a little bit too frothy right now. Don't worry. We'll hold your hand. We'll make it a little bit less scary. We'll be your lifeguards here on this program. Maybe you're looking for a financial advisor. We can also arm you with what they should be up to, what they should know, what they should be doing in these turbulent markets. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fine network upon which you find this program right now. If you're enjoying this show, Remember, it's only once a month. There's a whole bunch of other great shows there on the network you should be subscribing to if you haven't done so already. About a dozen or so. We'll keep you busy. We'll keep you informed. We'll keep you armed with the latest options, content, and education and unusual activity, all that good stuff. So if you haven't done so already, make sure you subscribe to the full network. And, of course, keep those questions, those comments coming. We do love to hear from our listeners out there. And joining me on the Old Advisors Option program today, we got our usual cast of characters, plus a rotating guest star joining us yet again. Let's start off, first off, all the way out in the hinterlands of the far north, where we are joined once again, like twice in a week. How am I so lucky here? But Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the Advisors Option, sir.
Great to be here. An historic week. Looking forward to breaking it down with the top crew, Mark.
Yeah, it should be a fun one. Then we're going to take that dial. We're going to dial it a little bit down farther out east and into the Atlantic, where we are joined in Puerto Rico, a place we all would have been last week, if not for this virus, by our old friend, Mr. Chris Hausman, the portfolio manager and managing director of risk, a.k.a. just the director of risk over there at SWAN Global Investments. Mr. Director of Risk, welcome back to the program. To you as well, sir.
Thanks, Mark. I missed you guys down here this past week, but I'm sure we'll hook up in the near future, hopefully.
Hopefully you had a fun Cuban cigar and some other fun in our honor, in our absence, really, over there. And last but not least, we're going to dial that clock arm all the way back around again to the south and back over to the west, to Florida. We're joined once again by Mr. Eric COTT, the Director of Education and Business Development over there at the OIC. Mr. COTT, welcome back to the program, sir.
Mark, thank you for having me. Great to be back with Matt and Chris.
And there's a lot to break down, so let's get to it. It is time to get the buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options. So we do it for you. It's time to get the buzz.
All right, everybody, welcome to the buzz. Like the man said, this is the portion of the show where we break down what is lighting up the world of options and derivatives that maybe you, the financial advisor and asset manager who's busy actually taking care of your clients, didn't have time to pay attention to. And it's a very buzzy market yet again here. Once again, listeners, we have our advisor's option, and a lot has happened since our last episode. So let's break it down. Remember, we were talking on our last few episodes about what was going on from a volatility and overall sell-off period. The last time we all gathered here together was kind of right off the tail end of just the madness that was the sell-off in March. We were hitting circuit breakers. It seemed like almost daily, huge 4+% swings in the major indices pretty much every day, sometimes much more than that. VIX was threatening ridiculous levels that closed just off recent historic highs. Volume was through the roof. There were crazy times, and we were saying if it was a recovery, it would probably look pretty aggressive, perhaps in that V-shaped mode. Well, it seems like we are perhaps a portion of the way up back on that quote-unquote V-shaped recovery. Our audience seemed like they were pretty savvy. We asked them right around the time of our last show, what camp were they in? Were they kind of short the market and riding it down at that level? Were they starting to nibble at long positions, or were they sitting in cash? And about 54% said they were sitting, or I should say nibbling at long positions. So that seemed like it worked out pretty well. Or perhaps not, because we also asked our audience about exactly a month ago, pretty much the time we did this last show, we said the S&P had just closed past 2,600. Do you feel this is real, or do you feel this is a bit of a dead cat bounce? Effectively, where will we be a month from now, higher or lower? And about two-thirds, almost 64% of our audience was fading it, saying we're going to be lower a month from now. It was a dead cat bounce. Well, lo and behold, coming into today's show, pretty much exactly a month from that poll, and we're at 2886 in the S&P right now. So a good almost 300 points higher than that 2,600 level. So at least for the folks who were fading that rally, the market has, of course, decided to move the opposite and keep moving up. Of course, that means our old friend Vol, a.k.a. VIX, has retreated a bit coming into today's show. We're seeing the VIX cash at about a 33, so well off its highs, upwards of 80 not too long ago. And, of course, in the interim, we've all learned Some of us, we had heard about it theoretically, but we all learned that crude oil could actually go negative. This is a thing we saw. We actually saw listed strikes in the negative range there for WTI, which of course set the market a tizzy, threatened a lot of popular ETPs you guys like to trade, like USO, and of course sent the crude options and futures market going crazy. Other negative rumors, we've been hearing rumors about maybe the Fed playing with negative rates, so a lot of negative things are on the horizon as well, which brings us to our show today. A lot has happened since the last time we got together. So let's go around the horn first and get everyone's thoughts on what they're seeing, what they're feeling, what their thoughts are on the current volatility regime, the current market valuation, and some of the other issues we hit on last show, like the issues with liquidity. Matt, we'll start with you. I know you actually came out on the last show and said you were somewhat embarrassed as a former market maker to see just how wide spreads had gotten, how light the displayed liquidity in the options market was. I'm curious, what are your thoughts on that? Have you seen market improvement since our last show? And also on where we find ourselves right now from a volatility and evaluation perspective, what are your models telling you, sir?
Yeah, the widths of the market were terrible. And not in SPY particularly, in some of the bigger ETFs and indexes, but once you got past just a few symbols, you got the stocks, the single stocks, and they were just so wide you couldn't even trade for a while, and that's not very good. I mean, we've been warning about this as an ex-market maker. We were talking to the exchanges, and we've talked to the exchanges at these OIC events about what's happening in the non-popular names. I mean, you have so few market makers now that they don't care so much about these non-popular names, and it's so difficult to get in to be a market maker. I think those, they can't. No one is really watching those single stocks, and so they just blew up. And we do analysis on every stock every second, and you couldn't even draw a good skew through things. And they've improved greatly, as things have quieted down. But that's going to leave a lasting impression on investors if they can't get out, if they can't do anything. I mean, I'm on some of these, and I saw some comments of it from retail investors, and they're just, very angry about how the market's gotten, and so am I. So I hope someone could do something about that. The exchanges, and I think it has a lot to do with, market makers, fees, and all that. So that needs to be addressed. And I wish we were having an option industry conference so we could, that's a good chance for us to talk to the exchanges. As far as the market goes, yeah, I mean, volatility, we had some good calls and some bad calls, I'd say. Volatility spiked, and, we identified, kind of maximum pain pretty well. The markets got really wide. The put call slopes got really wide, or really high, I should say. Implied volatility got really high, and that ended up being the bottom of the market. And then as the volatility started to fall, we watched that. We watched the contango backwardation, and I thought we'd get a turn down, but it just kept on trucking. And we find ourselves now, not too far from where we started, really, with all that's gone on. It's shocking to me. But as I've said in the past, like I think week 3 and week 4, we're in week 3 of earnings. Now week 4, you're going to start to see some of these companies, talking about earnings, and these are typically the earnings weeks that have the highest returns to option buyers. These are the weeks 3 and 4 that see a lot of movement in stocks after announcement. So I'm expecting some volatility in the next couple of weeks, but we'll see what happens, Mark.
Yeah, I think all of us were surprised by the aggressiveness of this V leg coming up right now. Our audience clearly wasn't ready for it either. So yeah, of course, by no means is this a done deal. We could be selling off again in the near future. This pandemic gives and it takes in terms of just from a purely markets perspective, from an overall health perspective, it just takes. But still, it's interesting to watch. Speaking of the markets and, of course, the virus, Chris, you guys over there at SWAN have been putting out a lot of interesting content on this front, markets in crisis, coronavirus outbreak, a lot of other things like that. So walk us through that. And also, the last time you were on, we were talking similar to what we were talking about with Matt there about you obviously trade a lot in the SPX. Things had gotten wide. The SPX had gone all electronic for the first time in its history, so there were concerns about liquidity there. Walk us through how it's been getting things done, size trades out there in the SPX compared to last show. Has that improved? And also, what are your thoughts on this current quote-unquote V-leg of the recovery and where we find ourselves from a valuation and from a volatility perspective, sir?
Well, the markets have certainly slowed down here. I don't think any of us would have ever said that with the VIX being 30 plus back in 2017. But yeah, we haven't had any issues getting things done. Again, we do trade the most liquid products, and Matt, has a great points on some of the other products that aren't as liquid. I think that first 2 weeks when everyone was working from home and the exchanges shut down, that was new for a lot of people. So we were able to work through that like everybody else was. But things are very smooth right now, almost back to normal. You can't even tell that there isn't a pit out there. Things are a lot more fast right now as far as getting quotes and just executing. As far as the recovery here, well, there's three words that where you keep saying, right? V-shaped recovery. Yes, it's shaped like a V, but I think the question we got to ask ourselves right now is this really a recovery? It was very quick up, but it was also very quick down. And don't forget, the amount of stimulus that the central banks around the world, and the Federal Reserve have been pumping into the economy right now. I think 2008, and all the stimulus packages that they passed back then, which we thought were huge and a bunch, well, they're doing more and more and more, and it doesn't seem like there's any end in sight. So I think Q2 is either going to be written off because nobody knows what's going to happen right now. There are companies that they're not providing any type of guidance because they don't even know. So I think this V-shaped move up it's definitely technically based because we were deeply oversold. We needed some kind of a bounce. I do think that the bounce and the size of it's taken everyone a little bit off guard, but you have to turn it around and say, well, you know what? We're not too far from the 200-day moving average. If this is really a bear market, that should hold as resistance. And I think this is a great opportunity for people to reassess their portfolios. Hopefully you didn't sell out at 2,200 or 2,300. You had some hedging in place and you were able to stay and weather the storm. But this is a great opportunity, a great place for people to look at their portfolios again and see if they want to reload on hedges, and protect themselves for a potential down leg. And an interesting note, the term structures have gone back into contango, but there is a hump about 3 months out. And that's kind of, that means, maybe things are starting to open up with the economy slowly. I think there's a lot of finger crossing going on right now. Well, what's really going to happen, with the virus, et cetera, and how our state's going to really open up safely. But there's still some risk out there. And I think there could be a new wave of data coming 2-3 months. And I think the option markets are kind of showing that right now.
Yeah, we are in weird times, and we'll get to all the earnings numbers in a little bit with Matt, but we're seeing companies coming out and, like you said, Chris, effectively saying we have no idea what the future holds. We can't possibly predict it with this pandemic, and we've never really seen that before in earnings season, at least not in recent history. Yet the companies are still rallying off of effectively no guidance. And we all know at the end of the day, the earnings call is all about the guidance. It's not what have you done for me lately. It's what are you going to do for me tomorrow, really, that matters. And they can't give you any guidance, and yet the companies are still rallying. So we're in a very rarefied air with this V could easily turn into a W very quickly. Eric, one of the things that certainly hasn't been turning down and looking down really is options volume over there at OCC. I mean, these are obviously not the circumstances that anyone wanted to drive a lot of options volume, but we also know when there's turmoil in the broad market, when there's turmoil across the globe, that usually tends to drive volatility, which tends to drive volume. So walk us through what kind of numbers have you guys been seeing over there at OCC lately, Eric?
Yeah, and I appreciate that, Mark. And also just to jump on to Chris and Matt's comments here, one of the things is that we were all together almost a year ago at this time, Mark, in Miami at the OIC conference. And I was very fortunate to have Matt on a panel talking about entrepreneurs and their benefit to the options marketplace, especially given ORAT's analysis as we're in earnings seasons here. And then Chris as well. Chris was there, I think, thanks to you, Mark, as a first-time guest, kicking the tires of the conference. And we're sorry that it didn't take place in Puerto Rico last week. But, what's interesting is, Chris's firm with SWAN has been doing a lot of analysis and some really good insight for advisors. And, Chris just talked about this. I want to get to the volume in a second, but Chris just mentioned that there's sort of a brief pause here as communities are going to reopen. Investors and their advisors are kind of looking at the situation as if maybe, being in Florida here, maybe the hurricane passed by us, but we should be looking at some sort of insurance here. How do we hedge ourselves in case that next storm comes through? So I think, Chris eloquently said, this is a chance for people to talk to their advisors or their asset managers to maybe sort of reassess now as the markets have bounced, as you said, Mark, with this V-shape. But, as far as the OCC goes, we were up about 62% from a year ago. We had our highest volume month ever, Mark, last month. And, again, even with the situation of people being at home, and kudos to OCC, the Option Clearing Corp, because we went through a business continuity model to kind of figure this all out last year. And although we've had a large portion of our employees at home now, the markets have been very efficient. And, you talked about SPX going all electronic. We've also seen the floor kind of clear out, NYSE and SIBO. And now there is discussions that I guess the NYSE might be bringing folks back to the floor. So I think we're seeing some bright spots here. And, I hear from out in the field that advisors are talking to their clients proactively right now as we've seen the market sort of show some rise here.
I just wanted to add one thing about the polls that you always do. You should have the alphabet soup recovery poll and stay away from letters like, V, L, J. I mean, everyone's throwing out letters right now, but you should get some crazier letters out there and ask your listeners, what kind of recovery is this really going to be shaped over the next few months?
I think we could do that. Our listeners were fading this one, so they probably weren't buying into the V. So we'll have to come up with maybe a Q-shaped recovery. We go around and then down a little bit, all sorts of weird shapes we could touch on. But Eric, you kind of touched on it there a little bit earlier. One of the reasons I like having you on the program, not just for your scintillating personality, but you have your finger on the pulse of what's going on in the options-oriented advisor space. These days, it's a digital finger on the digital pulse because no one can really go anywhere. But that said, you kind of touched on it a little bit earlier. Is that what you're hearing from meeting with virtually and participating in events virtually with advisors right now? Are their phones ringing off the hook for people looking for protection? Are they looking to maybe get back in? Or they're buying this recovery? They want to get back in with both feet? What are you hearing anecdotally out there as you're engaging with the advisor community, sir?
I think, Mark, from the consensus from a number of advisors I've spoken to, that there has been concern from their clients. I think that everybody, and Chris and Matt just said this, everybody's sort of trying to take a perspective of certain states now gradually going back this week, and Florida being one of them, I guess. But from the advisor perspective, it's proactively staying in front of their clients, talking about the unknowns. And clearly the options markets are showing that. But what could take place, and having that dialogue about hedging downside risk here, that they were, Mark, you said this on the last program, advisors were sort of talking their clients, off the proverbial, they were talking about, to kind of be cautious about reallocating right now. They didn't want to talk them off the porch here and come back to reality. And now where things are, I think this is a true test. Matt's going to talk a little bit about this in terms of earnings. Advisors have said, that they are paying attention to the next couple of weeks, as Matt alluded to. But I think that the theme is more about going into the summer and then the fall. And is it a time right now to think about protecting a portion of the portfolio, because we're not quite sure what's going to happen in the third and fourth quarter?
Well, normally, like you mentioned, Matt, this is normally where I would toss to Matt and say, we're going to get a break from all things pandemic, talk a little bit about earnings, but these days you can't divorce one for the other. The really earnings season, every call is dominated by what is the impact of this COVID-19 on firm X, Y, or Z. And then on top of that, we're seeing other interesting wrinkles out there, including something that usually is sacrosanct in the market, things like dividends that firms tend to protect at all costs, suddenly going the way of the dodo. Mr. Matt, I know you're the keeper of all the earnings data. I want to hear that, but also you guys track a lot of other things like what's going on with the dividends. Maybe let's start there. What are you seeing in terms of firms canceling their dividends? Then we have a lot of eyes right now glued towards earnings season. It's the craziest week of what's probably going to be the craziest season for some time. What are you seeing on the earnings volatility front, sir?
Yeah, good points, Mark. One of my favorite terms or acronyms is EBITDA, earnings before interest, taxes, and amortization, and coronavirus.
I was going to say, I'm not familiar with the C part. I like that. That's a new one. I like that one.
So, yeah, I mean, these earnings calls have, they've really skirted any guidance. It's almost get out of jail free in some cases. But, as I mentioned earlier, a lot of these companies that are coming out are the ones that move a lot during earnings. So I think we're going to see a lot. But yeah, and also, where the rubber meets the road, dividends, right? So we, ORATS has a dividend fee. It's one of our bigger products, and we use implied dividends to forecast what's going on. And we've really seen the implied dividend, and that's kind of been fun to watch. We have this chart that goes and gets all of our historical data information, and we could track what the implied dividend has been over time. And when we were crashing and going down, they were really thinking that the dividends were going to come out. But now the implied dividend has come up, but there have been quite a few in our list that have canceled. And, you can understand the ones in the particularly hard hit sectors of hospitality and travel, especially in automotive. We've seen some pretty high profile dividend cancellations with no guidance on when they're going to come back. So, yeah, I mean, it's a double whammy there, earnings and dividends. They can't really provide much guidance. So investors, how do you navigate this? And no wonder there's a lot of volatility. One of the things that I thought was interesting, I heard a gentleman from Artemis talking, and he was saying that there's a gamma effect. And what the gamma effect is, it's really the negative gamma effect. Is a lot of these firms are still negative gamma short options. Of course, that's not what we tell or talk about here, but a lot of firms are short gamma. And what's happening is when the market's going down, it goes down faster because people are covering. If you're negative gamma and the market goes down, you're getting longer, so you need to sell. Conversely, when the market turns and the market starts going up, you're getting shorter, so you need to buy, so you exacerbate the move. So that's a lot of what we've been seeing in this market, and just one-way moves, and who knows what the earnings complex is and how that's going to affect it. But I think if they do turn this barge, because of this gamma effect the other way. I think, and it could happen in this, next week. This is a busy week, but the next week is the really volatile week. I think it's going to happen in one of these next 2 weeks, Mark.
Yeah, these are crazy times for pretty much on every level you can think of. I do like that. I learned a new acronym today, EBITDA. It's a terrifying new acronym. Hopefully it is not around with us for long. Speaking of terrifying, it can usually be scary for firms to go out there and plan for somewhat unprecedented events like this, like the pandemic. That's exactly, Eric, what you guys over there at OCC were doing in somewhat timely fashion. You ran a pretty big pandemic preparedness event back in last November. Not quite exactly what we're dealing with right now. That was much more fast-hitting type of influenza, I believe. But still, at the end of the day, the impact was the same. Everyone had to do social distancing, had to work from home, a lot of those kind of things. I think the Journal even picked this up recently. So it sounds like you guys have been a little bit on the forefront there of the old pandemic planning at OCC there, Eric.
Yeah, I have to say, Mark, I really want to give credit to all the leaders at the Option Clearing Corporation because we were ahead of the curve. And in our Dallas office as well as Chicago, we did go through these routines and preparation for people working from home, and we kind of analyzed what might be some of the hiccups with technology. And obviously, as you know, OCC being the largest equity derivatives clearing firm in the world, this was important to stay ahead of the curve. So I want to, obviously give a shout out to you for mentioning that. And I think it was a well-represented article about how the efficiencies of the derivative markets have been now during the last couple months, but also for our being prepared early on. And I think that bode well in terms of how things are running smoothly, and that the markets are quite efficient.
Well, I mentioned earlier in the show that just last week we all would have been gathered together for the Options Industry Conference in scenic and sunny Puerto Rico last week. We all would have been seeing the Director of Risk in person, as tan as he is over there these days. Unfortunately, as you know, that did not come to pass. Most major events these days canceled or put on hold for the foreseeable future. But that doesn't mean, Eric, that there weren't some events recently that you got to sneak into right before all this went down, including the big TD event where they were talking, and usually options are not a big focus of a lot of these advisor-oriented events. So when they are, we take notice. And Eric, you said you actually attended this session on effectively how RIAs can use options to improve performance, a topic that, as you might imagine, is near and dear to our hearts. So listeners, if you weren't able to attend the TD event, luckily, Eric was there for us. Eric, you said this was an interesting event. What were some of your takeaways, and what was the audience into? What were the panelists suggesting when it came to how RIA should be using options these days, sir?
Well, I have to say, Mark, had I hedged myself and collected as much hand sanitizer in the exhibit hall, I think I would have done quite well.
You would have done well on the secondary market, sir. On
the secondary market, had I known that. But it was interesting. Mark, you've worked with the folks at TD, and I know that Chris, and Matt know them as well. But there were some former sell side gentlemen that are now on the buy side who are sub advisors, much along the lines like SWAN is. And it was serendipitous that these folks were on a panel. There were three sub-advisors talking in early February, I guess it was, so really just a few months ago, about hedging downside risk, looking at put spreads, and even entertaining the idea of adding collars. And I think that the majority of the audience, who are advisors who clear through TD Ameritrade, their ears were perking up. I mean, it was still, we were in a bullish run here, and if you don't see the storm clouds coming, I guess you're not really mentioning as much to your clients. But it was just interesting that within 5 weeks after that, Mark, all this started to unravel here around the world. And I have to say, that the advisors that were up on stage talking to their fellow colleagues have been in a really good position now. And this is kind of a little shout out for a study that we did last year that we released, which Mark, you, Chris, and Matt were there for, that we were sort of talking about for institutions, about hedging strategies. And that study was released, and it is on the optionseducation.org website. But that also, advisors who had been talking to their clients about implementing strategies, mainly strategies to buffer downside risk, in these last couple of months, have seen these clients not only happy about what has happened with their asset allocation, but they've also made some recommendations to these advisors, friends and colleagues of theirs who have other advisors. They've referred them, to these individuals. So really, a turn of events.
Yeah, we're always happy to see different events spending some time in the advisor space talking about options. Obviously, that's an important agenda item of ours here on the program as well. It's like they had three different advisors talking about kind of their approaches to using options. Of course, they came in using the old standby of buying puts. We'll get to that in a second, how effective that might be. And then also another advisor, like they recommended selling puts, which is popular these days in a lot of environments for getting into different equities and indices and other underlyings at levels you may have predetermined, and taking advantage of some of the volatility we saw to do that and get a little bit of income stream. On top of it, it costs about, put selling and people getting into using that as a way to lever. And another thing that was mentioned that we said many times is often the holy grail for advisors. They talked about the collar, which I thought was interesting. Although it wasn't entirely not contentious on the panel there. One of the advisors pointed out that he likes doing collars, but he's leery to sell the upside because his clients get mad at him when the stock rallies. So if you are going to use a collar, make sure you're comfortable with both levels of that, listeners, the covered call side and the put side. Otherwise, perhaps a collar, maybe a put spread or something might be more effective for you. But at the end of the day, they all have the same takeaway, which was that no matter how you use them, and again, this is something that we've been saying on this program from episode 1, is that however you use them, if you're an advisor who uses options, it will help you stand out from the crowd. Because still, to this day, this program's been running for a little bit, and it's still hard to imagine, but there still are the vast majority of the advisors out there have no concept what a call or what a put are, listeners. So if you just do that basic bit of education, just listen to this show, you're already ahead of 95% of your competitors out there. But kind of interesting things out there. We talked about buying puts. Another interesting piece came out. Now, Eric, you kind of found this one for us. It's not an article I had seen. It came out actually late August of last year. But kind of interesting data. We're always talking about use cases for hedging on this program. And obviously one of the most common mainstays for hedging is just buying a straight-up put. Now, obviously, that's expensive. We talked about many ways here on the show to mitigate that risk, whether it's the aforementioned collar, whether it's using a put spread, whether it's using a put spread with the collar, all sorts of other things you could do to try to mitigate the cost of that put. But some interesting analysis done over there on advisor perspectives about are puts really the most efficient way to hedge your portfolio? And there's a lot of different data here. I'll try to break down some of it. And Eric, I know this is your interesting one you found as well, so I'll let you chime in there as well. But effectively, the article they had analyzed was entitled Pathetic Protection, the Elusive Benefits of Protective Puts, and that appeared in the winter 2019 issue of the Journal of Alternative Investments. A lot of interesting takeaways. They said a put option's protective armor is nearly impenetrable over drawdowns, that coincide with the option's expiration cycle. But they say the rub is a lot of these drawdowns exceed or don't line up nicely with the option's expiration cycle, and that's where people run into issues. That's something we said many times here on this show. Obviously, options have a finite lifespan, so getting the hedge on in the right amount of time, in the right period, that's always a challenge. And they say here, unless the options purchases and their maturities are timed just right around equity drawdowns, they may offer little downside protection. And they studied various scenarios using puts versus divesting some of the equity portfolio. And they found that the divested portfolio nearly universally had a better drawdown characteristic than does the protected portfolio. There's a whole bunch of statistics they cite here. I'll let you go find the article for yourselves here, listeners. And they say the quality of protection that puts provide, that improves when the maturity, again, is most closely aligned, peak to trough, with the actual drawdown itself. They say monthly options do a less, quote-unquote, less poor job of protecting against drawdowns that last about a month than they do those of about a year. So obviously a long-term drawdown, you have to roll more. The puts are going to get more expensive. So obviously that makes sense. And they also say puts do have an upside, which is, of course, the reason most people get into puts to begin with, is that they can keep their upside while protecting the downside. They say in those scenarios, they say that the put blows the doors off because you still have the upside there versus the divested portfolio where you have surrendered a good portion of your upside as a result. So there's a lot to break into. They also cite other articles and other studies that analyzed holdings from 96 through 2014 and put findings. There's a lot to break down here. Eric, we'll start with you because this one kind of came across your radar first. What are your thoughts on this article and saying that puts at the end of the day aren't as effective as some people might have thought?
Well, we didn't think that March or April of 2020 would come along. So it's interesting, Mark, that, I was shown this article and this story, and I know the author a little bit from being in the conference circuit, but I was shown this from some other advisors who, Mark, you just mentioned this, and I'm really glad that more and more people are listening to your show because this is a really helpful tool for them to get more comfortable and aware that option strategies could fit different types of scenarios. But relative to the study, and and put buying is that, I really talk to advisors a lot, and the analogy that I make is, insurance costs money, and there is a give and take, and you and the advisor and their client have to agree upon it. But that sleep well at night, I mean, look, Mark, we've talked about it on the show here before and in person, and I know I've talked with Chris and, Matt about this. Look, some of the biggest users of options are insurance companies when they have to hedge these living benefits on, annuity products. And so they're buying, long-term options and such. But, you have to look at this from a different perspective, and every client is different. Every asset allocation, every kind of objective is. So I think there are merits to the study, absolutely, as there always are. But look, I mean, the clients working with their advisors right now, and given the scenario we've had over the last 60 days, are quite pleased at the protection they put on.
That's a good point. That's something these studies never quantify and can't manage, and something that the advisor always bumps into, which is the client's worry factor. Someone should really be able to quantify that. If your phone's ringing off the hook, even though you got this less than diversified portfolio, your client's still freaking out. They can't sleep at night. That's not really a benefit to anyone out there. I'm sure we all have a lot of thoughts on this. I have my own thoughts on this, and it's a very interesting piece here. Mr. Director of Risk, since you spend your days buying and rolling and hedging puts and paying for puts out there, I'm sure you have a lot of thoughts on this. What are your thoughts on this article, sir?
Yeah, I'm very familiar with this piece when it came out. Eric said it, right? Insurance does cost money. So if you can develop some type of program where you can help to offset that cost with other option strategies, then it's a huge benefit in the long run, which is what the defined risk strategy does. The defined risk strategy isn't just, long underlying and long insurance via a put, but we also have income producing strategies that are there to help offset. And then once you're able to offset these costs, these dynamics, the data of the study changes quite a bit over a full market cycle. Now, I've always said, and I've said it on this show, every hedge has its day, right? Like every dog has its day, and it really depends on market movement. So, trying to time the put hedging with market movement, of course, it's going to outperform because you're talking about, and we already alluded to the gamma effect here on this show, right? They're going to protect more and more, if you're able to match up that maturity with market movement. But that's also extremely difficult to do. I mean, look what just happened in such a short period of time. So strategies like the defined risk strategy are not going to help during quick V-shaped recoveries, but they are more about capital preservation over long-term market cycles. And that's really what investors are worried about. They're not worried about, small 7%, 5 to 7% sell-offs. They're more concerned about, what is going to help preserve my capital base over the years to come.
Yeah, at the end of the day, it's all about the outlay. And they mention if you're going to just keep buying monthly puts, going through an extended 1 year protracted drawdown, that second month, the first month might be all right. And it's going to be pretty reasonable if you buy it ahead of time. Once that sell-off continues through that put, that second month's put's going to be pretty darn expensive. Insurance, at the end of the day, does cost money. And that's why we spend so much time on this show trying to mitigate that cost. So hopefully your returns will be a little bit better than what they found here. Matt, you're the keeper of my data out here. Obviously, you do a lot of back tests and analyzing of your own. What are your thoughts of the findings in this article, sir?
Some of those people at the TD conference actually are users of back testing. I can't say which, but so I'm happy about this. But I think some big points are about the benefits of compound interest, which is a very big thing. And what people don't talk about enough is, and actually Warren Buffett has his Rule 1 and Rule 2. Rule 1 is don't lose money. Parenthetically, it's because it really hurts you on compounding. And Rule 2 is don't forget Rule 1. So, the big thing is not to lose money. And even if insurance is expensive, it helps you follow Rule 1. Don't lose money. Now, as Chris said, that puts are expensive, and there are ways to produce income around that, especially when you have the protection of puts. We've talked about this quite a bit. I like the put, very long term, far out of the money, over hedging, meaning buying more puts than your portfolio is worth, and then doing some raising of capital, either a put spread or a put 1x2, depending on skew and opportunity there, and then being a little bit nimble. and that's the harder part. I understand, but even if you aren't, you're still going to be doing well when the market goes down. When I was on the show here, Mark, and I said, listen, the volatility market has changed. It looks like this coronavirus is going to do something. So you're able to see it once in a while. When you start seeing the implied volatility rise, that's the time to get out of some of those shorts, and it helped investors and myself protect from getting out of those income producing and still living on the long put. So and now, I think it's a great opportunity to re-hedge, as Chris said as well. Volatility has come back down, so you can start to get into those puts again. But when vol's really high, you can find some very good put spreads. And we have these scanners that are continually looking at. You don't necessarily have to get the SPY, the Qs, the IWM. Even some of the sector spiders have obviously high correlations. You could find some very good put spreads, put calendars. There's a lot of ways to buy units down there in the low strikes to protect you in case something does go haywire again. So those are my comments on those. It's easy to boohoo protection, but there's a lot of very good reasons to have it, and those of us like me and the SWAN that had protection on are quite happy now, Mark.
Yeah, there's so many different ways to dice this onion, right? If you just look at it from a pure, straight-up perspective of a divested portfolio versus this over this X amount of time, and just a straight-up, very basic, very vanilla 5% out-of-the-money put, and yet that's so little of what we talk about here on this show, like you mentioned. So much of what we talk about is reducing the outlay, which is going to improve the performance. Also, there are various ways in certain scenarios where if you just keep buying that same 5% out of the money put every month, that's not going to perform that well. It's going to be a huge drag on your portfolio, particularly as the drawdown continues out there, which is why we talk about alternative ways. And I was hoping to get to, as Matt just mentioned, the ratio put spreads, but I don't want to do that topic short shrift. I also want to make sure we have some time for you guys here on the shows. I think we'll save that discussion of short put spread, or I should say ratio put spreads, versus your old traditional short puts and fun use cases there and using ratio put spreads as a way to lever into some positions, maybe where you're a little bit concerned, like this article shows up, and that just straight up buying puts perhaps not going to do it for you, and certainly just selling puts may be a little bit scary for you as well. We'll talk about how to use ratios to do that next episode, but we're going up against it. I'll make sure you guys have some time to join us. So without further ado, it is time to hang out our shingle because it is time for the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours where you guys get your chance to ask your questions. We also like to turn the tables on you every now and then. Chris was joking at the top of the show about our regular polls out there to our audience. We asked an interesting one at the tail end of last week about all the turmoil in the crude oil space, crude going negative for the first time in its history. That impacted a lot of products you guys like to trade out there for your clients, including USO. I know that's a popular one out there, even though we've been somewhat dismissive of it for the various issues it has with contango and roll yield out there. But we thought we'd ask you. A lot of people were worried it might follow the path of XIV and head on out into the Franken product dustbin of history. So we asked you guys quite simply, you think USO will still be trading at the end of the year? And it was a little bit closer than I thought out there. It was about 55% yes, 45% no. I was surprised at how almost evenly split our audience was. So let's go around the horn. Maybe you guys have thoughts on that. We'll get to some of that. But first, Matt, we need to make a correction. We have I love our audience. We have such keen-eared listeners that even a small discrepancy in a data point they will bring to our attention. This one, actually, they brought to your attention, Matt. This came from Glenn Wolf. He said, I listened to the Advisors Option podcast. If I heard right, you predicted that we would go down to 180 on SPY, as that was the 2016 election low. Is that the equivalent of what SPY would have been traded at based on SPX futures overnight on election night? Looking at the SPY chart, I don't see a 180 low around November 2016. Maybe it's because it's a monthly chart or something. Thank you. Greatly appreciate the insight. I love our audience, Matt. They're very keen-eared. They pick up on these things. What do you want to say here for Mr. Glenn, sir, and anyone else who maybe heard that?
Yeah, no, it's great to be able to be corrected. He emailed me directly, and you guys feel free, matt@orats.com. Chris never makes mistakes, but I still make one once in a while, Mark.
That's why he's the director of risk. It's baked into his title, sir. That was just, I think, a slip of the tongue there on the show. It happens to the best of us here on the program. Thanks for pointing that out there, Mr. Glenn. Matt, a courageous man to put his email out there for you guys to correct him directly. We talk about hedging and the efficacy of doing that. Well, a lot of people had on their radar the recent big hedge from the Ackman funds out there, including our listener, Angelo. Angelo says, looks like the Ackman hedge worked out brilliantly. Maybe this will be a wake-up call to more long equity managers that they need to have a hedging strategy in place other than liquidating their assets. So Angelo kind of taking the complete counterpoint to what that study's author just said in the Buzz segment. If you're not familiar with all this, talked about it on the network a few months back when this hedge went up, listeners. But effectively, Ackman out there with his funds had a pretty sizable outlay, and when people were saying it was a straight-up bearish bet, we obviously looked at it on the network as more of a hedge, and that was exactly what it was. He was hedging his long equity portfolio. They like to talk about net outlays in these broad financial articles, so in this case, this was Forbes, and they crunched the numbers and said he spent about $27 million out there, and that hedge turned into $2.6 billion. They obviously sold that out, and they used that to help reestablish a lot of their long positions. So we talked about the director of risk. Maybe we'll get his thoughts. Mr. Director of Risk, you have any thoughts on this relatively now notorious hedge put on by Ackman? And maybe is this the counterpoint to what we were just talking about in the Buzz segment earlier about how it can work out well if your timing lines up right, Mr. Director of Risk?
That's exactly what I was going to say. Here's a story where hedging is working out. Now, think about what he's doing on the second part of this article. He's repositioning in all these different companies, right? So he's buying low, hopefully to sell high. And it's kind of exactly what the defined risk strategy does is, when we rehedge our portfolios at lower levels, we're monetizing the insurance, right? The puts, exactly what Ackman did here. And that gives you the ability to buy stock at cheaper prices. And that's what you want to do here, right? You want to buy low and sell high.
Yeah, he actually came out and said, hedging was preferable to him than selling off his portfolios of companies whose businesses are otherwise strong, including Chipotle. He mentioned Hilton, Burger King, and other ones. He didn't want to sell those, so he hedged them. And then he took the profits he made and he spent about, it looks like $1.5 billion reestablishing new positions in Starbucks and a bunch of those other names that he likes out there, which is exactly the point of hedging. To begin with, Mr. Matt, any thoughts here on this relatively notorious but well-timed hedge here by Mr. Ackman and company?
That's a tough way to go, calling it and then hedging. But there are other folks out there that are like SWAN, buying these and providing protection. Nassim Taleb and the Universa Fund comes to mind. And risk mitigation there, and I think they made something like Mark Spitznagel made something like 3,000% on this down move. But and we've back tested some of what we get. They're pretty tight-lipped about what they're doing at Universa, and we've back tested what we think they're doing, and it works out when it works. But on these periods of higher volatility, it's a bit of a bleed. But again, there, as in any market that moves a lot, you're going to have these stories. But I mean, it's the kind of the consistent people that form a strategy and follow it that are the ones that are the long-term people that are going to profit from investing over the long term, Mark.
All right, let's see if we can squeeze on one or two more here. Next one, I like the handle, El Dorado. Hope you found your city of gold there, El Dorado. He wrote in after our last show, wanted to say, do you see a lot of pushback from advisors who prefer to use inverse ETFs as their hedging strategy as opposed to options. Like a lot of hedging talk on the show today. I wonder why. And he includes a link to an article called "Watch Out, Bloodbath in Levered ETFs." It came from ETF.com. And the takeaway was that over the past, I think this came out right around the time of our last show, over the past 2 weeks, we've seen a bloodbath in levered and inverse exchange-traded products with almost 30 ETFs and ETNs seeing the cessation of trading sometimes overnight. And this gets back to the poll we just did earlier with USO. USO not in the inverse or indeed the really levered position, so not quite the same thing. But at the end of the day, when you're trading, and I call them Franken products, only somewhat tongue-in-cheek. At the end of the day, they're trying to replicate something else using a variety of different approaches to do that. In the case of a USO or a VXX, they're trying to usually replicate a front-month future. These days, USO's all over the place. So they have issues with roll yield, and these levered ones, guess what? They're using a bunch of derivatives or certainly the inverse as well, to achieve those inverse or those levered returns. And how they do that, how well they hold up, particularly we're seeing, like we saw on the last show, markets were extremely wide. And yet... especially these crazy Franken products have a hard time in normal markets making these returns that they promise, let alone in crazy wide, crazy thin markets. So it doesn't surprise me that we're seeing a lot of these inverse and levered products go the way of the dodo, which is why we give you that caveat out there. If you buy a put, it's expensive, but you know it's going to be there. OCC is there standing behind it. It's not going to go away. Even if markets are halted, and people have asked us about this even on the last show, you can still exercise that option. It still exists. Whereas these levered things, when things get crazy, they tend to go the way of the dodo, which is why we're always very cautious. And people like them. They're easy. You can put them in a portfolio. I got SDS against my S&P. I'm good. Yeah, that's there's dangers in all of these things. Mr. Director of Risk, I know you're not the biggest fan of all things inverse or levered ETFs. What do you have to say about our listener El Dorado, who's perhaps concerned about advisors using these in lieu of more established things like puts, sir?
This goes with understanding the nuance of your product. You're talking about USO. Once upon a time, we used to talk about a product called XIV, and it comes down to math, especially with the levered products. I mean, remember, if you lose 50% of a portfolio, now you need 100% return to get back to break even. So imagine those types of numbers, and you're in a levered product, and that's why those types of products can get into trouble very quickly. So again, just be sure that product fits what you're trying to do and that you understand all the nuances. I think a lot of people don't understand the nuances of products. We learned that the hard way in XIV, and I think people are learning that in USO. USO has been kind of a staple go-to product for many, many years if you wanted to play oil, and all of a sudden, there's some chinks in the armor. Now they're changing how they're rolling, right? They're changing the rules, in the middle of a game because they can. And so that's something that we need to you need to focus on and always understand what can and cannot happen in certain products. I do want to come to Matt's defense a little bit because S&P 500 minis did hit 18.25 in February of 2016. So it wasn't really right around the election, but it was that year, which would put the spiders right around 180.
There you go, standing behind your fellow contributor here on the program. Unfortunately, listeners, that music means we've come up against it. This show flies by when we're talking hedging and pandemic risk and volatility and all the other things that make up a great episode of the Advisor's Options, including your questions. Keep them coming. We do love to hear from you, even your corrections. We love it all. We love it all here on the program. But before we go, let me go back around the horn, check in with everybody, see what they have cooking that may interest you. Let's start with Mr. COTT, sir. I know you're not traveling hither and yon these days, but still, you have a lot of things cooking over there in the land of OIC that may interest advisors. If you got any teases for us, have at it, sir. Then if folks want to learn more, they want to kick the tires for themselves, where should they go? What should they do, sir?
Thank you, Mark. And I'm going to also echo Chris's comments. Matt is never wrong, and Matt just participated on another show today with one of my colleagues, Joe Burgoyne. So we want to thank Matt at ORATS for all his participation with OIC. But speaking of OIC, folks can go to optionseducation.org. We have a plethora of material and resources as well as digital offerings. We'll have some webinars upcoming for all types of investors as well as institutions and financial advisors. So there's a whole menu, Mark, on our website. So I want to encourage everybody to do that. And I really look forward to seeing Chris and Matt and you, Mark, in person very soon. Time will tell, but I think we'll be approaching that hopefully before the end of the year.
I didn't know Matt was doing double duty on me here with Mr. Joe. I may have to talk to Mr. Joe about that. Stealing my people here on the show. But if it's not too much trouble, Mr. Matt, if you don't have another show with Joe to run off to, if folks are intrigued, they want to contact, because obviously people have questions about these puts and the efficacy. Maybe they have their own back tests they want to do. Maybe they want to talk about earnings or the cancellation of dividends or all the other fun data that you guys are crunching. Where should they go? What should they do, sir?
Yeah, come on over to orats.com. Our latest is we're working with Tradier. It's an online brokerage. They do quite a bit with advisors over there at Tradier. And we are the real-time providers of theoretical values, Greeks, you name it. So we're pretty happy about that. We have some really nice scanners where you can go in and use a back test, set it up, and find the best options in real time. So, we've got a lot going on at ORATS. Hit me up, Matt at orats.com, Mark.
There you go. Matt at orats.com is the place to go. And last but not least, he's hanging out in sunny Puerto Rico. Mr. Director of Risk, I mentioned at the top of the show, you guys have been doing double duty over there in Swan Land of late, really just cranking out a ton of content. So listeners, if you want more in between episodes of the Advisor's Option, and quite frankly, why wouldn't you? They have articles like Markets in Crisis, what's going on with the coronavirus outbreak, or how you should hope for the best, but prepare for the worst, and talking about some hedging efficacy there. So Mr. Chris, if you got some interesting stuff, lighten up the Swan site, let our listeners know. And also, if they want to learn more and they want to check it out for themselves, where should they go? What should they do?
Yeah, I was going to mention that one. Marco, one of our other portfolio managers here, wrote a great piece with, like you just said, hope for the best, prepare for the worst. Kind of talks about investors, how they can make certain missteps in investing. And usually that's a result of popular misconceptions. So the piece goes through a bunch of different misconceptions, but at the end it ties it beautifully together on why hedging can provide a lot of benefits to a portfolio, right? Like transferring risk to uncorrelated assets, reducing impact of volatility in bear markets, and most importantly, offsetting losses from major market events. And all that's at swanglobalinvestments.com.
There you go. SwanGlobalInvestments.com is the place to go. In between episodes of this show, because everyone has questions, I know you do. Check it out. A lot of great content, including links to a fun show like this one. So if you enjoy this episode and you want to check out more, that's a place you could go as well. And on behalf of the Director of Risk and Mr. Matt, the keeper of all the data over there at ORATS Land, and indeed Mr. Eric, who's not going anywhere right now. No conferences. He must be chomping at the bit over there. But he's got a lot of virtual events to check out. And indeed myself. I want to thank all of you out there for downloading, for streaming, for subscribing, for sending in those questions or listening live, or all the fun stuff that you guys do. Keep it coming. And we'll see you back here next time for more of The Advisor's Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.